Good morning, everybody. This is Kirk Spano on Investing 2020s. If you are listening on a podcast and would like the slide deck, just go over to Fundamental Trends and sign up for the free special reports library, and you'll be able to get the slide decks that I post on the website. Oh, today I mentioned something in the chat room at Fundamental Trends. I said, for what it's worth, I'm pretty sure the reason the Fed has gotten behind the curve is they don't want the federal funds rate above 1.25%, nor do they want to shrink their balance sheet. If the dollar gets stronger too fast, we would see a massive global collapse. That was something that in the video that we just glanced at from Tom Lee, who predicts a 17-year bull market powered by the millennials, talks about as well, is that the federal governments of the world really want to keep interest rates as close to zero as possible because they owe so much money. And that is going to be a problem throughout the world, especially the developed world, going forward. And at some point, developed countries could ask the emerging world for the debts that they owe. If you've ever read a book called Confessions of an Economic Hitman by John Perkins, I believe his name is. I read it quite a while ago. What you realize is that the emerging markets have a pretty legitimate beef with the way that that debt was created. It wasn't very straightforward. So we could see debt conflicts in the not too distant future, particularly if rates get too high. So in the context of a 17-year bull market that Thomas Lee is forecasting, we should think about a few things. First off, where are we in that bull market? And the answer is fairly early, and I'll show you a chart to that effect. The second thing we ought to consider is, did we get ahead of ourselves? And I think the answer is pretty clearly yes. So here we are, going all the way back to 2014-15, and you can see this area here, where the stock market operated within a 15% range for over 2 years, just breaking out a little bit in 2016, but then coming back. So from the bottom corner of this box to the top corner of this box was approximately 2.5 years. That is the consolidation period that I have cited over and over and over again as being the spot that set up the next bull market. And as you can see, when we got our tax cuts and cheap oil, the market rallied. Then we had a volatility event in 2018 and the market rallied again, largely stimulated by the Federal Reserve, which printed $1 trillion in the second half of the year to bail out the repo markets. And then we got the COVID crash, the economic heart attack, where everything fell off a cliff. And I believe it was 17% unemployment got to pretty much overnight. Now suddenly, if you saw the jobs report this morning, we actually have a shortage of about 10 million people for getting the jobs done. And it's not really that the people don't exist. There's about 10 million open jobs and about 10 million unemployed people. But there's a big skills mismatch and a desire of people to get higher pay. And people asking for higher pay is one of the things driving inflation. However, it's actually the smallest thing driving inflation. What is driving inflation the most is the fact that oil went from 0 to 90 in about 1.5 years, and that supply chains haven't been moving for about a year. And why haven't the supply chains been moving for a year? I think part of it is the logistics system gaming things. I think China has been a problem with their zero COVID policy that is finally starting to fail. And ultimately, energy prices come down with the expansion of alternatives and the supply chains clean up because people need to make their money on what they've built. How long will that take? I believe it clears up this year. Both things. I think oil peaks in the next few months, if it hasn't already, and the supply chains are pretty cleaned up by the end of summer, early autumn, right after Christmas at the latest. So we've got about a year of inflationary pressure to go. So how does that all impact the markets? Well, we had the biggest stimulus in history from the Federal Reserve, other central banks, and federal government. We got this sharp rally in the face of what really probably would have turned out to be a depression. And just like we fixed things after the Great Recession in 2008 and 9, we fixed things here. But I don't think the Fed understood or foresaw, I certainly didn't, that supply chains would get so mucked up or that oil would go up so fast. And the oil going up fast is largely a product of traders believing a narrative that will probably end up not being true. But for now, it's a great trade. And I will remind you that anything that's good for oil and gas is probably much better for alternative energy. Why? Because on par, they're about the same price now. When Ford and GM and all the car companies tell you that they want to move to EVs and they're advancing their programs to do so, when utilities are tearing down coal-fired power plants to do solar and batteries, you ought to listen. That's the big money telling you what's coming. How fast does it happen? Hard to know. We've talked about time frames before and the market reacting to the pace of change, acceleration or deceleration. So right now we are looking at a deceleration in Fed accommodation. The market has started to react. Will we get a violent rebound rally? Possibly. Tom Lee says that we will. Shooter at our service says that we will. I expect that we will. Do I think it'll be as big of a rally as maybe some people thought? I don't know. I think that after today's jobs report, the odds of a 50 basis point increase in the Fed funds rate in March has increased. One of the articles that I have in my queue is that the Federal Reserve could shock the world and then go on summer vacation. What is the theme of this article that'll be out soon? It said I think they probably will raise interest rates a half a point and then maybe sit on their hands if they get the reaction on inflation that they're looking for. Also during that time frame, maybe we see a deal with Iran. And Iran would certainly love to get another 1 million or 2 million barrels of oil on the market. So if there's a deal with Iran, and if there's an interest rate increase that's a little sharper than people expect, you could get the market shocked. Think of it like a pacemaker back to where it belonged. And that would be a reversion to trend, which we've talked about before. What is reversion to trend? Just means, I'm not sure why this is doing it this way, it means that we would see the trend come back to where it was. And we know that this is from a hugely overvalued state. So when valuations are screamingly high and accommodation by the Fed comes down, you'll see a reaction. Tom Lee, in the video that we glanced at, said as much. The Fed is the most powerful thing in the market. Now, there are time lags sometimes. Historically, the big correction comes after the Fed is done raising. Well, what if they do a big increase and then indicate that that might be it for a while? What would that imply? That would imply that they're a little bit concerned about growth and they don't want to talk about it. The markets can sniff things like that out. So I think it's pretty clear to me that our first major support is around 400 on SPY, maybe a little lower. There's this 382 fib level from the prior correction. Now, there are other levels, so we can pull it back from all the way back here, 2014, to the top. And that changes the equation just a little bit, not much. Support probably comes in right down here, where it jitterbugged, got through, came back. And this is actually the area that I've been targeting, is the middle 300s on SPY. So if we go through this first support, then the middle 300s become very viable. And then we have major support down here around 300. And that comes from the rally, the breakout rally during the repo bailout that failed on the COVID heart attack and then got back here. But you'll see jitterbugging here, jitterbugging there, and then a retest. So support normally moves up over time because of inflation, advancements of the economy, creative destruction. So you'd probably see support around 300. Now, what is this down here? This is the Armageddon zombie apocalypse scenario. And I don't know if the Fed would allow this, but this broadening wedge right here, pretty easy to see, lower low from 2018 to 2020. And how low would it have gone if there wasn't intervention? I think that's an important question to ask. If the Fed hadn't stepped up the way they did in March of 2020, we wouldn't have done all the bailouts that created the roughly $3 trillion of excess liquidity that's in the world right now. How far down would this have gone? And I believe it would have gone down to this level, somewhere under 200 on SPY. I think we got down to 222. So it really wasn't more than our 10 or 20%. I mean, could people have just completely panicked and sold everything? Maybe. If people had gotten desperate for liquidity, to have money, to live, they could have sold. The government prevented that. The Federal Reserve prevented that. And now there's $3 trillion of excess liquidity out there. So that means that what we have isn't a shortage of money in the global economy, especially in America. What we have is an allocation issue. So over the next several years, I believe we are just going to see a resumption of the technology-led bull market. And sure, there'll be a handful of materials and right side of the investment barbell to invest on. But I intend to have about 75-80% of my money on the left side which is technology, consumer interest, things like that. Tom Lee mentioned, and I've talked about this way back on Market Watch too, is that demographics are destiny. And in America, we don't have nearly as bad demographics as Japan, Europe, or China. Europe is trying to fix their problem with immigration. China's not even trying to fix their problem. They're encouraging people to have more babies. And Japan is insular. So to the point where Japan has allowed some people to come in and work, you're already seeing a pushback on that. So it's always the foreigner's fault, no matter where you are. If you're there, it's the foreigner's fault. If you're over there, it's the foreigner's fault. If you're over there, it's the foreigner's fault. What can I universally tell you about that? It's not the foreigner's fault. The United States has an incredibly strong economy, largely because we allow so much immigration. And we should allow more after the reduction of the last 4 or 5 years. And I believe that there is a wave of immigration coming. I believe there will be about 3 million people naturalized before the end of Joe Biden's administration, and it could be higher. Hopefully it'll be higher by a couple million. That would help our labor shortage tremendously. And if we focus on education and skills training, we can get a lot of the millennial men, there's 1 million of them, who have never worked full time, finally in their 30s and 40s into the labor force. And ultimately, if we're smart, we'll stick with the earned income credit as the main way to pull people out of poverty versus just giving them free cash, which I think we've seen for 50 years doesn't work that well. But the earned income credit, which is basically like giving everybody a raise who works pretty darn well. That gets people into the workforce, which is good for the economy, and it reduces the amount of welfare. Interestingly, this is exactly what Joe Manchin supports. Earned income credit versus child care credit. And I agree with that. Specifically, if we do the universal 3K. Once a kid is out of diapers, put them in the 3K. Let the parents go back and work, everything is good. And of course, 3K, 4K, and 5K are generally not full day. So it could work out pretty good, the way it used to for the older kids. Back when we didn't have 2-income families. And back when we didn't have so many single parent households. So are there a lot of things that we could fix relatively quickly? Sure. Over 3, 4, 5 years. But between now and then, what happens to this market? I think it simply becomes a function of what the Federal Reserve does in the short run. And the Federal Reserve wants to get back to trend. Trend is somewhere between this aqua line and this aqua line, or the 2 green lines. So the green lines represent a trend range that's based on low interest rates forever. The aqua lines represent a trend line that is more normal, 2-3% interest rate on the short end. I have a hard time believing that we get there. I believe that probably this higher trend is the way of the future, because I don't believe we're ever going to see interest rates rise too much. Ben Bernanke said it 10 years ago at a luncheon with people like David Einhorn. And I think you need to believe that. Interest rates probably aren't going to go up that much because inflation, based on global trends, fundamental trends, just don't support higher inflation. One of the things that Lee mentioned, which is something I've mentioned before, is unless you have high population growth, basically impossible to get sustained inflation because you're not getting the demand push. In a day and age where automation continues to increase, it's easier and easier and easier to get the hard assets out of the ground that we need because the machines are doing the work. Robots are doing the work. What would it take for a Ford robot that we've already taken looks at to go down in a mine and help mine, materials? It's already partially automated. There's less and less need for people to go underground. They just need to supervise. Let the machines do the work. Let a smart robot do it. Give them a chisel and a hammer. It's all coming. You've seen it in the movies already. The technology's here. Why wouldn't our ability to get hard assets become easier? It will. So again, in the short run, we're probably pretty challenged by a tightening Fed. But in the long run, I think I agree with Tom Lee. And you've heard me say that I think there would be a mega boom in the 2030s. I think that we're in for a very long bull market. I'm surprised that we got this huge get ahead of ourselves rally. But it was because of something that was unnatural, or actually natural, but unusual, completely unusual, the COVID crash. Had there not been COVID, this would have come down as a matter of course. We might have gotten another 2-year consolidation. That would have been the natural thing to happen at the start of a presidency. But we had this. So I would ask you, from this peak to this test, why isn't this area in here more normal in people's minds? Somewhere in the middle 300 on SPY. Maybe a little below, maybe a little above. It is. That is the normal place that we should be based on the trend. It's right in the middle of the trend. Go a little higher, a little lower. You saw that we're way above the mean of the trend. We're going to pull back towards it. Will we go through it to the downside? Will we get into the X zone? I don't know. I think something bad would have to happen. There'd have to be more of a financial crash in China or a war in Europe that was more than, a little shifting around of the pawns. What if Russian troops cross the Ukrainian border and our drones fire on them and wipe out 1,000 Russians? That could be really bad. I believe that we've threatened to use our drones to fire on Russian troops if they go into Ukraine. So that would scare me. I also believe there's it's a coin flip whether or not there's a deal with Iran on oil. In which case, sure, one good attack on a Saudi refinery and suddenly oil is $150 a barrel. That would be another heart attack to the system. So I believe that we're on thin ice. I believe the Fed knows that. That's one of the reasons they've held off for so long, is they want to make sure there's a lot of money in the system so that every correction is met with buying. And I think that that's what's going to happen. I was listening to Bloomberg this morning after the jobs report came in, and Rick Reeder from BlackRock was on, and he said that liquidity is tightening up, but in the same breath mentioned $3 trillion of excess liquidity. So that $3 trillion is slowly getting deployed is what he's saying. And then he said in the next breath, we're sitting on a pile of cash too. So if the big guys, and BlackRock is about the biggest you get, is saying we're sitting on cash, we know that liquidity is shrinking, what are they doing? They're just waiting for a buying opportunity. They're gaming the system. And that's why I don't think we get to IC. I think we get in here in this box somewhere, first major support, and then super major support, and that's where we really need to be big buyers of our favorite large cap. Of course, we've already seen the SPACs get destroyed, and a lot of small caps get destroyed. I'd just like to show you who the relative performers were in the last month. This is my expanded watch list. You got oil, got coals on speculation, Vail, which I added about a month ago, Total Energy, look at that, Discovery, Lockheed, BHP, Kinder Morgan, AbbVie, even Barrick. Oops. In the last 5 days, look what's jumped up there. Solar, satellite. Tom Lee mentioned space. I'm telling you, space is going to be massive. And the first mover satellite networks are going to be the ones that win, because at some point the governments say enough is enough. So the 4 satellite as a service stocks that we own are the ones to own because they're already up or in the process of getting up. Unity Software, talked about this a lot. Jumia, right? Africa, FinTech, Amazon, of course, which blow out numbers, Coinbase, and we have a lot of stocks. I mean, our list has done pretty well if you've been picking these off the floor. Now, if you're a trader, definitely some great trades to be made. I've already told you you can start inching into Jumia. We already own all the satellite companies. Coinbase, I'm just waiting for the washout on cryptocurrency. Open Door has done all right lately. Think of them as a Zillow with a flipping advantage. And when I told you a couple of years ago all the things that were going to happen with Ford? I'm telling you right now that all the things that happened with Ford weren't an accident. The writing was on the wall. The whispers were out there. The engineers were already doing the work. That's always a good tip-off. Open Door has pretty good management. They understand real estate. They went out and got a huge war chest of cash, but haven't deployed it yet. What are they waiting for? More on that in a minute. So, we have an overvalued market outside of the trend range. We have a Fed tightening, extremely high valuation. Got to get back within, for sure within 2 standard deviations, I think makes sense. But all in the context of a super long-term bull market that we've just gotten ahead of. We can see the put-to-call ratio has been jumping up and down, and right now is down. That usually means, you can switch this to a daily, that usually means it'll jump back up and the market's going to get hurt, and then the market will rally. It's just their inverse relationships. Look how fast this is moving right now. It's crazy fast. And if you go way back, you see right here, when the put-to-call ratio finally spikes, that'll be the end. That'll be the end of the correction. And then it'll come down. Because inevitably, 3 out of 5 people get their trade wrong, 1 out of 5 break even, and 1 out of 5 make money. That is pretty much the basic equation to all this stuff. 3 out of 5 traders lose, 1 out of 5 roughly break even, 1 out of 5 make money, and really the people who make a lot of money are just the top few percent, your shooters of the world. And remember, a lot of these options are on margin. So when the margin calls come, there's going to be a hell of a bad week or month, just like March 2020. Maybe just like March 2022. Triple witching is March 18th. I think that Federal Reserve is doing something in March as well. So going back to Open Door and some of the other tech that's out there, We see that home prices spiked on people moving to work remotely, and now prices are starting to come down in real estate. I've used the example of my condo complex, how prices literally jumped 20% last year and the year before, from 2020 to 2021. Now all of a sudden we have people pricing their condos at those 2021 peak prices, and they're not selling. I would expect that we get a very choppy period in real estate prices with a little bit more down than up. I don't see a 2008 crash because we're not leveraged up that way. A lot of houses out there actually have 20-30% equity. I forget what the average was, but it's a good number now. And this isn't hot money in most cases. A lot of these buyers were cash buyers moving from California and New York and other high-priced, high-taxed places, and they ran to cheaper places to live. So they would sell $1 million house with $300,000 of equity or condo or whatever, and they'd come to a place like Milwaukee or parts of Florida, Alabama, Tennessee, Texas, and get lower taxes and lower cost of real estate. I think I've told you what my brother's house sold for. He was on the Milwaukee River, about 1.5 acres of land, and a very old postmodern house that needed lots of remodeling. He did about half of it. He got almost $500,000, which seems like a lot here, but you put a 2,000 square foot house with a greenhouse attached, which is what I was envious of, on a river with 1.5 acres of land, almost anywhere else in America, and that's a 7-figure house, right? So think that through. This is going to keep coming down till it gets to a choppy range. I don't believe it goes into the red though. What does that mean for Open Door, right? They were smart enough in Q4 not to buy a lot of houses. And this is coming down. They're going to get an opportunity to deploy that cash. Single family home sales spiked and came back down. Inventory is going up later in the year with a lot of new condo projects and apartment projects. And ultimately, you're going to see a lot of office towers convert to mixed use, where the top floors or the middle floors, I don't know how they'll do it, will end up being condos. And it'll all be based on the piping in the building. I mean, you might just end up with, luxury condos because they only have enough piping for 2 or 4 bathrooms on the floor. So if you have a 10,000 square foot floor, might end up being 2 5,000 or 4,000 square foot condos, or maybe 4 at 2,500. How do I know that? I'm talking to a guy who's talking about doing it to a building in Milwaukee. Say, okay, what can we do with the way the building is built? One of the other problems actually for doing that ends up being a lot of windows have to be replaced, and that's expensive. But if Open Door does things the way I think they're going to do things, I think that this is going to end up being a pretty interesting opportunity to buy them on the cheap. Because once again, people who are good at real estate end up making a lot of money. And I think they're not just going to be a convenience service, but in the future they will be part of the gentrification of neighborhoods. Going to the edge of a neighborhood that's gentrified and pushing it out another block and another block and another block with private equity money that they have. And then as their cost of capital goes down, that way too. So I'm throwing out Open Door out there. Why? Why do I talk about things when I talk about them? Because I really want it on your radar. I don't know that it doesn't get down to 4 or 5. It could. They might need to dilute for something. The market might just not like them for a year or two. But ultimately, in a normal real estate market, where many, many boomers have to sell and generally sell quickly because they're having a change in life circumstance. I'm dealing with 2 clients right now going through that. Got a 95 and 91-year-old couple who over the last 2 years have really gone downhill. And I have a 75-year-old client whose husband just died. And she's trying to figure out what she's going to do. My advice is always go as slow as possible if you're healthy. But a lot of people aren't healthy. They have to sell their houses quick. An Open Door could be a way to do that. Get an offer. Get it done. Everything's done in 3 weeks, 4 weeks. Their technology and their capital structure and the way things are going in real estate with demographics is going to be very positive for them, especially if they don't get a ton of competition. Zillow already left because they screwed up how to do it. All right. I didn't have much more than that other than to tell you, when this gets down in here, you start looking at large caps. But you really should be looking at some of the emerging markets right now. The cannabis stocks you should be looking at. And I don't buy individual cannabis stocks because it's just too much for me to understand. But there you go. We're already through the first support on YOLO. And there's major support coming around 8. I added the Bollinger ranges back in here. And I moved all this stuff to the left side to make this easier to read. Then these numbers here are indications of volume. So right here, right where we are right now is actually kind of an intermediate support level. I think it probably comes down in here. I think we probably do get 9-ish or 8-ish. But I really think that if you're a growth investor, remember, cannabis, off this last dip down, which I think is coming, it's just screaming at you to buy it, because it'll triple. And it's going to break through this, because all these companies are starting to have recognized revenue now that they can slowly take part in the financial system. Did you think that was interesting in the previous video, where he talked about there's basically about a 5% toll to be part of the financial system, the banking system? Banks are taking huge percentages of your income every year for you just to have a bank account, through not paying interest and then charging you quite a bit. And the tech companies who operate within the traditional margin structure turn around and give you discounts. That's why you can get 1 or 2 or 3% rewards on a lot of stuff, like Apple Pay or your Amazon card. It's because the margins are that big. So one of the things that blockchain is doing is shrinking those margins. And that's why Coinbase is a big deal. That's why Ethereum is catching up to Bitcoin. Because all these financial projects that are happening are going to shrink the margins on financial transactions from 5-ish%, probably all the way down to 1-ish%, 80% reduction. Or look at it inversely, 1% to 5%, 5x. It's going to be a huge reduction in financial costs going forward. But what can a company like Open Door achieve if titling and transaction costs come dramatically down? As those costs come down, they'll pass on some of it, but not all of it. It's the same reason that the EV makers, the traditional car makers, are switching to EV so fast. It's because they see that with high oil prices, there's demand developing, and the margins are better on EVs than they are on ICE cars. And most people are going to get their service at the dealership in the future. Why? Because they'll have the technology. Not going to be a lot of small shops that have the technology to work on EVs. So if you're a grease monkey, pretty much you're going to have to retire at some point in the 2030s unless you adopt the technology to work on EVs. And I'm not sure how that would happen. I have to imagine that the government requires them to sell the technology or make it available, but I'm not so sure it'll be cheap. It'll come with a lot of training. So Ford and GM, with their dealership networks around the country, could be pretty interesting. Ford has come down today, and I think we're getting close to wanting to pull the trigger on that one. Keep an eye on it. Somebody asked if there's any opportunities in fixed income at all. You know, honestly, the bond markets suck. We have problems in high yield. Government interest rates are going up a little bit. The only one that I would own at this point is Ginnie Mae, because it's pretty stable and has the implicit guarantee of the government. And that's really just a way to get an extra point or two on your money market money. You'd be better off selling puts on some of the less volatile stocks out there, longer dated and further out of the money, and pick up 2 or 3 or 4% there over 6 months. So I'll do the retirement income options this week for that I'll release on Sunday or Monday, probably Monday morning, and talk about on Monday at lunch. The retirement income options I will do specifically as ways to beat fixed income with similar risk. How's that? Now somebody asked about EMQQ, and again, EMQQ, it's in the buy zone. For sure it's in the buy zone. I'd actually move this down to there. Right? I moved that down to there. I'm not sure why that wasn't saved. And then I also like this area right here. Low 30s. So I would say that you can start looking at it. EMQQ is about half Chinese, and you have to decide if you want to own China stocks. Actually, I'll just compare it to FM. Well, FMQQ is brand new. Not going to have much of a chart. This is EMQQ minus the China stocks. So even the rest of the emerging markets have plunged, almost 30%. So if you don't want China stocks, FMQQ. If you do want China stocks, EMQQ. Now you can use FMQQ and then KWEB if you want to buy China and the rest of the emerging market technology companies at different times. And I think I'll probably do that if these don't work in lockstep. So if we compare KWEB, which is China internet, right? You see that they've moved pretty much in lockstep. The rest, and as we saw on the FMQQ chart, they also have come down lately. So I don't think you need to use two funds. I mean, if you're okay with China, then you can just buy EMQQ. And I think lower 30s is probably the spot. Shooter will help us in real time in case it heads into the 20s. And it could completely round trip. I mean, I could definitely see it getting into the mid 20s, but that would be something bad happened in China, right? Or something bad happened in the world. The dollar got strong too fast. Somebody asked, would negative real interest rates be good for gold? I think that you can make that argument. I think you can also not make it. You gotta remember, gold as a tradable vehicle is hard to hold because it's cyclical. So you just have to buy the bottom of the cycles for the time frame that you're interested in and sell the top of the cycles. And you can do that on a weekly basis, a monthly basis, a quarterly basis, or longer term. But ultimately, I agree with Warren Buffett, who's a pretty good guy to agree with, that in general, gold is just a shiny metal with limited utility. More utility now than 20 years ago because of tech, right? Apple is a big owner of gold because they use it in their phones. But in general, gold is not the hedge that it used to be. You're speculating if you hold it as a hedge, especially in a day and age when it's clear at this point. And again, you have to get by your biases. Whether that bias is I don't understand it, or that bias is that this is just some newfangled thing. Bitcoin and Ethereum are here for probably ever. Ethereum could be replaced by a better version of Ethereum, still be Ethereum. Solana and Cardano, Polkadot, and a few others are going to survive. I'm not exactly sure which 10 or 20 cryptocurrencies survive. But even Tom Lee said that 97-98% of cryptos are going to zero. So he's a little bit more bullish than me, because I've said 99% of cryptos are going to zero. But that 1 or 2 or 3% that survives, they're going to be valuable because Bitcoin is digital gold, which is why physical gold isn't such a great tradable vehicle anymore, because the history, the thing that the Elliott waves would attach to, has changed. There's been a legitimate change in the world. They don't happen very often, but when they do, pay attention. So I really like Bitcoin as a store of value. I think it's going to get into the 20,000s. I've been saying that for a while. I don't know if it'll be 29,000 or 21,000. Somewhere with a 20 handle, and then I'll buy a lot of it. In Ethereum, you want to buy the pullbacks. It looks like, technically speaking, there's one more leg down on crypto, and that'll probably be our spot to buy Coinbase and Bitcoin and Ethereum and a couple of other companies like Square, Block Square, that have exposure to crypto. Somebody asked about Facebook, the exciting stock of the week. So Zuck kind of got zucked this week. Was he down $31 billion? I asked my girlfriend last night, my fiance last night, I said, hey, what do you think it feels like to lose $31 billion? She goes, who lost $31 billion? I go, Zuckerberg. She goes, wow. Well, how do you think that feels? She's like, I don't know. So do you think it feels the same as having $31 billion to lose and not change your life? It doesn't matter to him. He made a joke about it. Zuckerberg joked about it. So here's the thing with Facebook. Long ago on MarketWatch, I said that eventually, because I saw all this shit coming with the social media, eventually Facebook would be like that old telephone book, right, with the pages that go in and out, and you got to add pages once in a while, that sat next to your corded telephone. And that's what it's becoming, but with pictures. So Facebook's going to become a contact utility and putting up pictures of the kids. But I don't think you're going to see a whole lot of social discourse on it going into the future. I think people are over it. Why argue with your friend about something that you can't affect, right? The wisdom to know what you can change, when it might cost you your friendship. When it might play into the whole divide and conquer theme that the megalomaniac, greedy fuck class wants to do to us. When you have the governor of a state of Wisconsin tell you that divide and conquer is working in the population, I mean, he said it right on the radio. I had a continental breakfast with a big-time billionaire oil guy in North Dakota. There was ham in my breakfast, and he tells you we just need to cage these people up in the cities and keep them away from us, and make sure they have enough to eat. It should smack you in the head. There's some bad people out there with a lot of power and a lot of money. And we don't need to fight with each other over small potatoes. So whether you're a little left or a little right, if you can touch fingertips in the middle, maybe lock pinkies, it'll all be okay. But that's not good for Facebook. So with fewer people on Facebook, which is what they're seeing, and a shift to the metaverse, which Kevin O'Leary talked about the other day, Mr. Wonderful, they have a gigantic opportunity coming, but they have a cash cow that's dying. And it won't die all the way. Facebook will have the glorified Craigslist that they have on there too. You know, I could see Facebook, I still think Facebook and eBay would be a great merger. Depoliticize it, sell more stuff on it, see pictures of people's babies and the interesting sourdough bread that they made. And I think it'll be just one of these stable things. And it'll fund their expansion into the metaverse. And what Kevin O'Leary was talking about is that the big brands want to have a regulated metaverse. They don't want to try to sell their Nikes or their Procter & Gamble toilet paper and then Stormy Daniels comes walking down the street and flashes everybody. They want a regulated environment. How that all work, I don't know. Above my pay grade. But the big advertisers don't want Wild West. So Facebook has a role in that. Soon to be known as Meta. So I think there's probably a spot to buy Meta for the long-term investor, and it can be traded as well, with the idea that if a trade goes down on you, a long trade goes down on you, you just let time fix it by holding it. Because probably there is upside to Meta from a certain price. There's been a lot of elevator drops when earnings disappoint. And in fact, only about half of the earnings have beaten this quarter, and the outlooks have been weaker. That is very unusual. A lot of them are citing inflation concerns. I forget what my AI told me, how many times inflation was mentioned in quarterly reports, but it's a lot. PayPal cited inflation as a problem. Square did. Facebook did. And the three big companies on the cloud side, Microsoft, Amazon, Google, and then Apple, the other four of the four horsemen, they've all done pretty well. Why is that? It's because Apple had a new product. They always do well after that. But Amazon, Google, Microsoft are the three biggest cloud providers in America. And what have I told you for a year? Cloud is going to grow 500% this decade, largely on the data from space, but also 5G and sensors and everything else. You think the cloud is big now? Just wait. Interestingly, I saw a report that showed up in my research email that they're expecting a price war in cloud at some point because every little company is trying to get in on it. Even Iron Mountain, which I think is a crap company, they're making money on it. So they made the right call, even though they don't treat their people well and part of their business is dying. Iron Mountain and Facebook are kind of, you can kind of take a look at them and say, hey, look, they had a cash cow it's going to be less of a cash cow in the future, but they got a new cash cow that they're, growing from calf. Iron Mountain, same thing. Ultimately, I'm not as bearish on Iron Mountain as I was, because I thought they'd fail. But they had relationships, they capitalized on them, and now they're a very prime buyout target. Yeah, somebody says you should see the massive buildings in Las Vegas. Yeah, I actually have seen those. Yeah, it's pretty amazing. You're going to see so the deal with Intel to go to Ohio, you are going to see a massive influx of tech jobs to the Midwest because we got water coming out of our ears. Intel was just the beginning. You're going to see more and more cloud facilities in the Midwest. You're going to see more and more tech migrating here. That whole area surrounding Chicago, from Chicago, Illinois to Madison, Wisconsin, all the way up to Green Bay, and I don't know, towards Indiana, probably south of Chicago, which is the most boring country you'll ever see. It's just cornfield after cornfield, and all the way over to the Quad Cities in Iowa area. That whole area is going to do pretty well. You got the Mississippi River, you got Lake Michigan. Ohio's going to do well. Upstate New York, Michigan. I think that I missed my opportunity in Detroit 10 years ago. I should have bought, so we'll see. Somebody says that real assets generate cash flow and earnings. REITs, pipelines, strategic assets that are predictable and growing cash flow. Well, so here's the problem with simple, tangible, and understandable, is that REITs are cyclical. The only REITs that have beat the market in the last 20 years are storage REITs and industrial REITs. None of the other REITs have beaten the market. None. Zero. So if you take, and I actually have that, I've showed this before. If you take a look at the long-term return of REITs, this is the entire sector, 5-year returns, right? Got all those that lost money, a whole bunch that didn't do that well, and I can add versus the S&P 500, right? The whole damn list. So versus the S&P 500, you've only got a handful that have beaten. That's basically all of them right here, right? Turns red right there, right there. And what is it? It's industrial. If you take a look at these, it's industrial, industrial, storage. You go right through it. So REITs, there's a fallacy that they beat the market. It's two categories of REITs. Storage, because there was a shortage of houses that had storage space, and that'll change over the next decade as the boomers die, their houses become available, as inventory comes on. Industrial real estate, though, holy crap. You can make money in that because supply chains are moving back to America. That's why I focus on Stag and some of the other ones. A lot of the pipelines on the oil side are only filled at 50-55% capacity, and that's never going to go up. Maybe a few percent for a few years. Why? Because production's not going up much and demand's not going up much. So there is a handful of oil pipeline companies that you could say, I want to be part of their wind down, because as they close their oil pipelines, they'll switch to natural gas and hydrogen. But that'll be a very tough transition. And institutions don't want a lot of part of the oil pipeline. So there's not a lot of price support. So this rally, this bear market rally in oil, which is what it is carrying the whole sector up. I'm invested in Kinder Morgan. Why? Biggest natural gas pipeline network in America, biggest carbon dioxide pipeline company in America, and we're just starting to do carbon capture. And natural gas pipelines are a backdoor play on hydrogen. Oil pipelines can't do that. So you have to break down what is truly a real asset and what is a long-term depreciating asset. Oil pipelines are not real assets anymore. They're depreciating assets. It's like a used car. Oh, I love that beautiful used car, but year after year it gets more expensive to operate. So you gotta be very selective. So I'm A-OK owning Kinder Morgan. I'm A-OK owning industrial REITs. But the entire classes are not sexy. And in fact, they're pretty dangerous in many places. I like the cell tower companies too. I think American Tower has a lot of upside because of their potential deal to go even more international. So I've thought this through, and I've put my money where my mouth is. And I'm down a little bit lately, but not much, because I was sitting on cash. So if you want things that pay dividends, take a look at the list that I have out there, because those 15 stocks, right, I shortened it up to 15 stocks for you. Those 15 stocks, if that's in your portfolio, your average yield is going to be a little over 4%, right around 4%, and you're going to have growth on top and lower risk because they're favored industries, right? That's how you do risk management. You don't just throw the blanket out and say, I love REITs. Know which REITs to love. And obviously, if you're qualified to get into private equity deals and be illiquid, there's some pretty good private equity deals out there for people who are able to be illiquid for 5 years with that piece of money. Because the redevelopment of real estate is really where one of the biggest places are to make money, because you buy real estate at less than half its value, you fix it up and you double or triple your money. That's out there. That's why I'm pretty interested in that, because I mean, the worst case scenario is you have to just wait a cycle out to make your money back. So sometimes it takes 5, 6, 7, 8. Other times it takes 2 or 3. Somebody says the disappearing flyover country should be good for the U.S. Well, I don't know that it'll necessarily be disappearing. I think what you're going to have in the Midwest is that all the people who left the industrial cities in the 80s, 90s, and 2000s are going to come back. Not them, maybe their kids or their cousins or something, their younger cousins, their nieces and nephews. There's plenty of open space. Somebody mentions Blackstone. Yeah, that's on our list. Brookfield Asset Management. Problem with Brookfield Asset Management is that, again, it's a gigantic conglomerate. It's hard to value and it doesn't get a premium. But some of their, like BIP, some of their partnerships, which are now corporations, are pretty interesting. So the infrastructure one and the clean energy one are both pretty darn good. Again, you gotta buy them when they're cheap. So James says gold's not an industrial metal, demand mostly jewelry and emotional hedge. Yeah, I think that's pretty much what I said. Doesn't have a lot of utility. Although in the tech age it has more utility than it used to. Still doesn't make it a lot. I've always advised on gold, so round tripping there is buy yourself some pretty coins, some bullion that you can show the grandkids, right? The little bars. I mean, heck, if you want to buy a great big bar, go ahead, buy a great big bar. But yeah, the little ounce bars, and then cool gold coins from around the world. Did I hit Unity? Oh yeah, I said that was a crystal ball one. I like Unity long term. I hope it goes into the 80s. Hope it goes into the 70s. All right, I like all the satellite stocks too. Tom Lee talked about that. We're not wrong about the satellite stocks. They just went down further because, as Lee talked about, we have cognitive biases based on experience, based on being old and cranky, based on where we live, based on who we drink with or play golf with. Just know this, tech is still king, right? Tech is still king. So James, did I discuss nuclear power? No. Thoughts? Sure. My thoughts on nuclear power is that it's not going to happen in the next 20 years. I think at some point it will close the remaining gaps in the energy system as the big nuclear power plants get decommissioned. The day will come, and we're a generation away from it, but the day will come when we have incredibly low waste nuclear power, and it becomes so safe that NIMBY doesn't bother with it anymore, that it's not a big deal to have nuclear reactors that are as big as an apartment building and buried on the outskirts of town. That day is coming. It's not soon. And so uranium, that's just a narrative-driven trade. And if you can trade it well, go ahead and trade it well. But there's not really a shortage of uranium in reality, or plutonium. So it's not a supply-demand problem. It's a narrative-driven trade. And the reality is we're not going to use much of it for 20, 30, 40 years probably. Not any more than we already use. Yeah. You can talk about energy density all you want. Doesn't mean it's going to happen. right? People don't want nuclear power plants near where they live. It's just the way it is. We've built one. We've gotten one online in 30 years in the United States. So you can make the argument until you're blue in the face. Doesn't mean it's going to happen. You're never going to see another one built in Japan, I don't think. It's hard enough just to get the existing ones back online. And it does take 10 to 20 years to build one. I mean, I have a client who was on the project in, well, she ended up in Georgia, the one that actually did come online. But where was the other one? South Carolina? Somewhere over there. And that one ended up going through like half of the process, and then they shut it down. So yeah, India and China are building it because they have to. They have such huge populations, and it will eventually supplant coal, but it's just not going to be that many. It's not changing the supply-demand equation for uranium. It just isn't. I know the narrative is sexy, and people will believe it until it falls straight through the floor, which it's done before and it'll do again. You can trade anything. You can trade anything. But when you see studies and surveys that say that 80-some-odd% of people don't want a nuclear power plant anywhere near them, right? Yes, I agree with you, David. Nuclear will be around in a long time, and the small reactors will replace the big reactors as the waste product comes down. But solar is so easy. It's so easy. Seriously, it is the easiest solution out there, and the cheapest. Easy and cheap wins. All right, enough of that. Call it a day. Take care.